Your investment just made you $10,000. Congratulations. But here's the plot twist. Depending on how you earned that money, you might owe Uncle Sam anywhere from $0 to $3,700. The difference? Understanding investment taxes. Today, we're breaking down everything you need to know to keep more of your hard-earned gains. Welcome back to the channel. If you're serious about building wealth through investing, this video could literally save you thousands of dollars. We're diving deep into investment taxes, the rules, the strategies, and the costly mistakes you need to avoid. Section 1. The basics. Let's start with the fundamentals. When you invest, the IRS cares about two main things: how long you held your investment and what type of income it generated. First up, capital gains. This is the profit you make when you sell an investment for more than you paid. But here's where it gets interesting. The tax rate depends entirely on your holding period. Short-term capital gains apply to investments held for 1 year or less. These are taxed as ordinary income, meaning they could face rates as high as 37% for high earners. That's brutal. Long-term capital gains kick in after holding for more than 1 year. These enjoy preferential tax rates of 0, 15%, or 20%, depending on your income level. For most middle-class investors, that's 15%, a massive difference from short-term rates. Here's a real example. Say you're in the 24% tax bracket and make $5,000 profit. Sell after 11 months, you'll owe $1,200 in taxes. Wait just 2 more months for that 1-year mark? Your tax bill drops to $750. That's $450 saved just for being patient. Section 2. Dividends and interest. Now let's talk about the money your investments pay you while you own them. Dividends from stocks fall into 2 categories: qualified and non-qualified. Qualified dividends get the same preferential treatment as long-term capital gains, those sweet 0%, 15%, or 20% rates. Most dividends from U.S. companies and many foreign companies qualify, but there's a catch. You must hold the stock for at least 61 days during a 121-day period around the ex-dividend date. Non-qualified dividends are taxed as ordinary income. This includes most REITs, some foreign companies, and dividends on stocks held for very short periods. Interest income from bonds, CDs, and savings accounts is almost always taxed as ordinary income. The one major exception? Municipal bonds, which are often tax-free at the federal level and sometimes at the state level too. Section 3. Tax-advantaged accounts. This brings us to one of the most powerful tools in your arsenal: tax-advantaged accounts. These can completely change your tax game. Traditional 401ks and IRAs give you an upfront tax deduction, but you'll pay taxes when you withdraw in retirement. Think of it as a tax deferral strategy. Roth accounts flip the script. No upfront deduction, but all your withdrawals in retirement are completely tax-free. This is incredibly powerful for young investors who have decades for their money to grow. Here's the magic. Inside these accounts, you can trade as much as you want without triggering any tax consequences. Day trading, dividend investing, bond laddering, it's all tax-free until you withdraw. The annual contribution limits for 2025 are $23,500 for 401ks and $7,000 for IRAs, with additional catch-up contributions if you're over 50. Section 4. Smart tax strategies. Let's talk strategy. Tax loss harvesting is a game changer. This means selling losing investments to offset gains from winners. You can deduct up to $3,000 in net losses against ordinary income each year, and any excess carries forward to future years. Asset location is another crucial concept. Put your tax-inefficient investments like REITs and bonds in tax-advantaged accounts, while keeping tax-efficient index funds in taxable accounts. Consider the wash sale rule. You can't buy the same or substantially identical security within 30 days of selling it for a loss, or the IRS will disallow the tax deduction. Section 5. Common mistakes. The biggest mistake I see? Letting the tax tail wag the investment dog. Never make investment decisions based solely on taxes. A bad investment with good tax treatment is still a bad investment. Another costly error is not tracking your cost basis properly. Keep detailed records of what you paid, including reinvested dividends. Many investors overpay taxes because they can't prove their true cost basis. Finally, don't ignore state taxes. Some states have no capital gains tax, while others treat them as ordinary income. If you're planning a big sale or considering retirement, state taxes matter. Conclusion: investment taxes don't have to be scary or complicated. The key principles are simple. Hold investments longer when possible, maximize your use of tax advantaged accounts, and implement smart strategies like tax loss harvesting. Remember, this is general information, not personalized tax advice. Always consult with a qualified tax professional for your specific situation. If this video helped you understand investment taxes better, smash that like button and subscribe for more wealth building content. What's your biggest investment tax question? Drop it in the comments below. Until next time, keep investing wisely.